ETFs are a great way to invest if you're looking for a pool of stocks to invest in rather than owning individual stocks. It limits your risk, your downside risk in most cases. And so I thought that I would give you guys a list of 5 stocks for the month of June, or 5 ETFs for the month of June, that I thought were worth taking a look at. Now, if you're a part of the Chaos crew, you actually got this list a week earlier than I'm giving it to the rest of you now. So if you want this list earlier before the month of June actually starts, make sure you're hitting that join button next to subscribe and become part of the Chaos crew. It's $5 a month. At this point, it's less than a gallon of gas, more than likely, for those of you who are watching. So what do you have to lose? It just helps support the channel, and I certainly would appreciate it. So ETFs this week, or this month rather, that I think are worth watching, or ETFs that really took a huge hit back in May. And I thought that they looked pretty attractive, and I thought that I'd share them with you. What are the benefits of owning an ETF versus individual stock? The biggest glaring one is risk exposure. If you own something like a Google and it happens to tank 10%, the other stocks that are in that pool of the ETF, as long as Google's in that one, of course, will not have as dramatic of a drop, right? But the flip side of that is also kind of a benefit that doesn't really serve you if you're looking for high performance. So if Google rises 10-20% in I don't know, a week, let's just say, for example, and the rest of the ETF that Google is sitting in, or Alphabet's sitting in, might not move as high because it has other stocks that might have fallen during that period, or maybe not moved at all. So you're not getting that same type of performance move rather than just owning the individual stock. But also, obviously, you have that limited risk to the downside as well. So it really just kind of depends on what your risk tolerance is and what you're really looking for. If you just believe in a certain sector and you just want to be exposed to a tech sector or communications or what have you, that also stands to benefit for you as well, rather than having to go through all of the due diligence on individual stocks. So those are the couple of reasons as to why you would or would not own ETFs. So let's go ahead and get into the first one that I think is worth taking a look at this month. And that is none other than the XLK. If you guys aren't familiar with the XLK, that stock, or that ETF rather, is comprised of some pretty well-known names. It's all tech. It's Apple, Microsoft, Nvidia. Those are the top three. Those are the top 3 holdings. Then you have Visa, PayPal, MasterCard, Adobe, Intel, Salesforce, and Cisco. Those are your top 10 holdings in that one. The majority of this is taken up by Apple, Microsoft. About 42% of the ETF actually is taken up of Apple, Microsoft. Hence, why you have so much exposure there to tech. Take a look at the chart on the XLK. Let me go ahead and pull this up for you right now. Boom, there we go. So looking at the XLK, you can see that it's been in a pretty decent downtrend virtually since November. This is your high, actually since December. Your high was on December 29th, and it was $176. Came all the way down to 127. I mean, we saw what happened to big tech over the last several months, and really the overall stock market. But Apple obviously is one of those stocks, and Microsoft too. Those are 2 stocks that I always tell people you just gotta own them. Those are, to me, they outperform the market so well over the last decade and better, that I think that it's worth just holding on to them rather than just trying to trade them. We're coming up on the 50-day moving average on the XLK at $145. And I think that that's going to be a pivotal area to watch. We had a really good week this week, and I think that this has the potential to continue, just given how much this has come down. A lot of these tech stocks are finally priced at a reasonable level, and I think that they're very attractive. So that's why I think the XLK, really probably above all of the other ones in this list, is one to own. Now, I will say that just because this is one that I think is going to outperform all the other ones, it doesn't mean that you just go up and buy one ETF. It's also important to be really well diversified. And I think that, in my opinion, looking at more than one ETF to invest in is going to help you manage your risk the most. That's just my opinion, of course, but that seems to be the general consensus among all investing professionals as well. Now, the next one's going to be the XLC. The XLC is also very interesting. Those prices have come down. The stocks in those that ETF has come down considerably. Looking at Facebook, Alphabet, Netflix, Charter Communications, Comcast, T-Mobile, Verizon, Disney, and AT&T. Those are your top 10 holdings in that one. And so we look at something like Facebook, that's at 16 times next year's earnings, and Alphabet, that's at 19 times next year's earnings. Netflix, we know that story there as well. A lot of these stocks have gotten super beaten down. Disney, of all stocks that is in this ETF, also makes up about 6% of this ETF. And so that's going to have an influence, especially as we hear more and more about their parks opening up. And I mean, they're packed. Good luck trying to get a Disney vacation right now over the next 6 months. You just can't do it unless you're paying through the nose. So to me, I think the XLC is certainly one to take a look at, especially given how much has come down, and the heavy hitters in that stock, uh, Alphabet and Facebook in particular, are just so undervalued, in my opinion, that there's a lot of room for the XLC to potentially move. Let's take a look at the XLC right now. We're looking at the chart, and it's starting to heat up a little bit. You know, it came down to $55. It was up at 85 back in September of last year. Hasn't really thought about getting back to those levels during the span. So almost about 9 months, it hasn't even thought about going back or really changing direction. We're still in a downtrend, but we're starting to move in the right direction. You have the RSI sitting at 52. And as I'd mentioned before, the stocks that are the heavy hitters in this ETF are just so dirt cheap that you have good risk reward here owning the XLC. There's a lot of people that aren't too big on this because of what's going on with Verizon and AT&T and some of the growth issues there, and some of the issues just staying profitable. And so that's going to be a key to certainly watch for, but it's not necessarily the most influence that is on this ETF that is the XLC. Again, paying attention to Facebook and what Alphabet's doing. I mean, this doesn't just have Alphabet. It has two classes of Alphabet. It has GOOGL and GOOG. So that's Alphabet A shares and C shares. So that between those three, it makes up about 45% of this ETF. So that's the kind of influence that you're going to have on XLC. Next one is going to be none other than the XLE. And the XLE is the energy ETF. And this, to me, I think is going to be just one that continues to go up. Look, we just saw OPEC Plus announce that they were going to raise production by 50%. La-di-da, in my opinion. I think that the price of gas and the price of oil is going to continue to go up. And as we head into the winter months, I know it's crazy to think about as we're just now getting into summer, but it's going to be here before you know it. And I think that there's no relief in sight as far as supply is concerned. And the demand is still so strong in oil and in energy in general. Natural gas and oil in particular are all going to continue to go up, in my opinion, despite OPEC increasing the production by 50%. That still pales in comparison to the million barrels a day that we're missing from just Russia globally. So to me, I think that there is nothing more for me to say other than I think that this ETF is going to continue to go up, and I think it deserves to be in your portfolio. Take a look at the stock, or the take a look at the ETF on the chart, and you can see obviously it's been pretty extended, right? And I wouldn't argue that. I think that you could see a potential correction, maybe a small one, if it comes back down to $82 a share. I don't know. I think that maybe that is probably as far as we see it come in the short term, especially for this month. We're going to be in the height of travel. Demand's going to be insane. I don't have any reason to believe that this comes down and corrects to any substantial amount. Just went up to $90.46. That was the all-time high. And I know that it might look scary to you, but there's just no reason for me to believe that energy comes down anytime soon. And I would challenge anybody to tell me otherwise. The biggest reason that I could see oil coming down is if by some chance, which I don't think there is one, Russia gives up on Ukraine. If that happens, I think that we could see a small correction in that. And even in that case, things just don't go back to normal overnight. And I think that, Russia has burned so many bridges at this point that there isn't many countries that are going to want to do business with them anyway for quite a while. And I'm talking potential decades. So oil is going to continue to go up, in my opinion. And so that for that reason, I like the XLE. That is energy. You have some pretty major holdings in this one as well. Let's take a look at that. If you guys don't know what's in the XLE, you have ExxonMobil, you have Chevron, ConocoPhillips, EOG Resources, Schlumberger, Marathon Petroleum, Pioneer Natural Resources, which, by the way, has the highest dividend yield in the S&P 500, Phillips 66, Kinder Morgan, Williams Companies. Those are your top 10 holdings in the XLE. Next is going to be the XLV, and this is going to be very interesting as well. This is the health sector. So if you're worried about inflation, if you're worried about a volatile environment regarding interest rates going up and all of that. You got to go with companies and a sector that has all of the pricing power and also is very cheap, I might add. The XLV has the PE ratios in the holdings that make up the XLV are absolutely insane. The top holdings in this one are going to be the likes of Johnson and Johnson, United Health Group, Pfizer, Abbott Labs, AbbVie, Thermo Fisher, Merck, Eli Lilly, and others as well. Medtronic's in there too. The big heavy hitters are going to be Johnson and Johnson, United Health, and Pfizer. They're going to make up about 25 to 30% of this ETF. And looking at this one, it's actually sustained really well. I mean, you look at the rest of the market, right? And how the S&P 500 corrected 20%. You have the NASDAQ that's corrected 32%, as low as 32%. And so that's not what's happened here in this XLV ETF. This has been a really decent place to hide your money. Of course, it's been a little volatile, but either way, if you had bought this at the beginning of the year, you're kind of flat. It's better than being red on as compared to what the rest of the market is doing. This one and the XLE have been ones to own throughout this entire year so far. And I think that they're going to continue to be leading into the rest of 2022. Next one is going to be the XLY. And XLY is going to be the consumer discretionary side. This is going to be one that I think it also has a lot of upside just because of how much it's gotten beaten down. The XLY is comprised of some also familiar names that you might be familiar with. One of them, obviously, being Amazon, of course, is one of the major holdings in this one as the top holding. In fact, makes up 22.5% of the ETF. Then there's Tesla, Home Depot, Nike, McDonald's, Lowe's, Starbucks, Target, Booking, TJX. All well-known companies, all well-known names. You get to own all of them with this ETF that is the XLY. Things have come down considerably on this one. Tesla makes up 14.25% of this ETF, which you can see this has obviously been influenced by this pretty heavily because of the moves that we've seen in Tesla recently. Amazon as well. Amazon's had a monster move from around 2,000 to 2,500 as of recent. I don't think that there's much slowing this down, especially because Tesla's come down so much. I think that we could see a really decent bounce on this one. And obviously, you have some really great stocks in here as well in Home Depot and Nike and McDonald's, which they all gave pretty decent outlooks as well. The consumer is very strong. And for that reason, I like the consumer discretionary ETF. I think it's going to do well, not only in June, but probably for the rest of the summer. It's had an incredible bounce from $136 from all the way up to 157 as of recently. And even with that bounce, we've seen the RSI not move all that much. It's sitting at 52, so risk reward's good. We got plenty of runway here. The 50-day moving average is sitting at 167-ish, and I think that that's probably a good spot for it. I just think that all 5 of these ETFs are actually pretty good places to look for. If you're looking to manage risk, you're not looking to own individual stocks. If you guys are in the ETF game, take a look at these and see if you like them. If you don't, let me know in the comments below what you are looking at and what you prefer in the ETFs moving forward in this month and maybe even for the rest of the year. Would love to hear from you. Give me some insight on what you guys are looking at. Also, make sure that you're checking out the video that I just put out the other day on Microsoft and why they lowered their guidance and how this really big issue with exchange rates could impact the global economy as a whole moving forward. I think you guys will really enjoy that one. So thanks so much for tuning in. Make sure you like, subscribe, hit that notification bell as I'll be back tomorrow at 3:45 p.m. Eastern time to go live to cover all the earnings that are going to be coming out on Monday. So thanks so much for tuning in. I'll see you then.